It's Q4 of the fourth year in crypto's 4-year cycle, and it's crypto's fourth cycle since Bitcoin launched in 2009. And this means it's going to be up only until the end of the year, right?
Right?
Well, not necessarily. Even though the end of the year has historically been bullish for the crypto market, it's not going to be plain sailing. In fact, history suggests that volatility is likely to increase as we approach crypto's cycle top. And that's why today we're going to tell you everything you need to know about Q4, including when crypto prices could pump or dump, which indicators to watch, and how high your coins and tokens could go. My name is Nick, and you're watching The Coin Bureau. First though, nothing in this video is financial advice. It's educational content intended to inform you about crypto in Q4. And if you want to see more content like this, then smash that like button, comment down below, and let's get into it. So, the fourth quarter of 2025 started a week ago, and Q4 has historically been the most bullish period for the crypto market, particularly in the fourth year of the 4-year cycle. And yes, we are in the fourth year of the 4-year cycle, and happen to be in the fourth crypto cycle. To put things into perspective, Bitcoin's Q4 return in 2013 was almost 500%. In 2017, it was over 200%, and in 2020, it was almost 200%. For Ethereum, its Q4 return was almost 150% in 2017, and it was over 100% in 2020. This is all according to CoinGlass, and yes, Bitcoin, Ethereum, and most cryptos historically saw most of their gains going into Q4, with Q4 containing that final blow-off top. And if you watched our recent video about the altcoin season, you'll know that the underperformance of most altcoins going into Q4 of this cycle is one thing that's been different about this crypto cycle than the others. You'll also know that the reason for this is crypto's maturation as an asset class. As the crypto market matures, more capital becomes concentrated in the top cryptos, regardless of how many cryptos there are. But let's back up a bit. Why has Q4 historically been so bullish for crypto? Well, there are two reasons. And the first has to do with macro, particularly institutional flows in the markets. You see, institutional investors will typically allocate more to the markets going into year-end to impress clients, make solid returns, and whatever else. The result is that stocks tend to perform better in Q4, just like crypto. On that note, what's different about this Q4 for stocks is the fact that retail flows have reportedly been dominating in the markets since the spring. And this is because institutional investors got spooked by Trump's Liberation Day tariffs back in April. Institutions have thus mostly been sidelined, which is also part of the reason why the September effect didn't occur this time around. It was also caused by those institutional flows. And that's why this Q4 is likely to be very explosive for stocks. Institutions who've been sitting on the sidelines are now underperforming, and they need to catch up to keep their clients happy. And this means that institutions are basically going to have to ape into the markets in the next few months, and it's possible they'll allocate to alternative, riskier assets like small cap stocks to make up for most of the lost gains. And if you need evidence of that, look no further than what happened to large cap stocks, small cap stocks, and the crypto markets on the 1st of October. They all started exploding higher. While it's possible some of this was related to speculation around the US government shutdown, it's likely that most of it was the result of institutional investors adjusting their allocations for Q4, which you'll recall begins on the 1st of October. But that's just the macro side of the Q4 story. The crypto side of the Q4 story is just as interesting. You see, the crypto market has a habit of transferring coins and tokens from paper hands to diamond hands over the course of a cycle. For the purposes of this video, let's just say that the crypto cycle starts at the bear market lows. Now, take a second to ask yourself, who typically buys the dip at those extreme lows? Obviously, it's the diamond hands, the investors who believe in the long-term potential of crypto, be they institutions or retail. And as you will no doubt know, DCA is a very popular strategy in crypto. That's dollar cost averaging. So, What happens after the bear market lows, where everyone has capitulated and believers of crypto's long-term potential start gradually buying the dip? Of course, prices gradually start to recover. Eventually, the Bitcoin halving comes around, and this does two things. First, it cuts the new supply of Bitcoin in half, and that restriction of supply makes Bitcoin's price rise, all else being equal. And second, and more importantly, the Bitcoin halving tends to bring attention back to crypto. Investors who capitulated during the bear market lows notice that Bitcoin's price has recovered, and maybe they start allocating a bit too. The caveat is that these so-called crypto tourists are the paper hands. They sold all their crypto at the lows thinking it was over, and the only reason they're buying back is because they can see that it's not. Naturally, the main reason they're buying is to make a short-term gain, hold for a year or two, and then sell when there's a rally or a cycle top. The catch is that the paper hands can't handle the volatility along the way. The result is that these paper hands are the first to sell whenever prices go up and whenever they go down. And this is essentially why it takes so long for crypto prices to climb out of their bear market lows. Every rally and crash results in crypto tourists selling out of their newly held positions. Meanwhile, the diamond-handed believers keep gradually buying, allocating more to their favorite cryptos whenever they dip. And if you need evidence of that, look no further than all the on-chain data analysis being done by the likes of Glassnode. They found that when short-term Bitcoin holders are sitting on large profits, the chances of a pullback tend to rise because they're likely to sell. On the flip side, they found that when Bitcoin prices fall sharply, the short-term holders tend to sell, with the long-term holders buying up their coins. As such, you could say that the reason why Q4 of the fourth year of the crypto cycle tends to be so bullish is because by that point, enough of the supply of large cryptos like Bitcoin and ETH has moved from the paper hands to the diamond hands for rallies to become more sustainable, liquidations notwithstanding. It's just that the supply of crypto gradually becomes more restricted as demand continues gradually rising. As the rallies become larger and more sustainable because of these supply and demand dynamics, speculation starts to creep into the crypto market, eventually resulting in a blow-off top that marks the end of the 4-year cycle. After that blow-off top, there's a cascade of selling caused by liquidations, eventually resulting in the bear market lows where only the true diamond hands are left. And if history is any indication, the final blow-off top of the crypto market could be just around the corner. And if you want to make the most of it, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of $100,000, trading fee discounts of 50%, and deposit cashbacks of up to 75% on the best crypto exchanges around. Now, to get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. Now, these deals won't be around forever, so take advantage of them ASAP while you can using the link down below or the QR code on the screen. Back to the video. So, now that we understand why Q4 tends to be so bullish for the crypto market and why this is especially true in the 4th year of the crypto cycle, we can finally look at a few indicators that will guide us through this volatile period. Speaking of which, I probably should have mentioned that earlier. Q4 tends to have the highest returns for both stocks and crypto, but also tends to be the most volatile. With that in mind, there are 2 indicators you need to watch closely in the coming weeks. One macro and one crypto. The macro indicator to watch closely is the US dollar as measured by the DXY. Now, for context, the DXY measures the US dollar versus a basket of other currencies, mainly the euro and the yen. And it's important to keep this in mind because deviations in the euro and yen can also cause the DXY to deviate as well. Anyways, the reason why you need to watch the DXY is because it effectively determines how much liquidity there is in the global financial system. For reference, liquidity refers to money, and most money is debt, and most debt is denominated in US dollars. And that's why when the DXY goes up, everything else tends to go down, and when the DXY goes down, everything else tends to go up. And this begs the question of what causes the Dixie to go up or down. The short answer is macro catalysts like US inflation data, US unemployment data, and the Fed's interest rates. Lower inflation, higher unemployment, and lower Fed interest rates tend to result in a weaker Dixie. But remember, the Dixie can also weaken or strengthen because of factors specific to the euro and the yen rather than the USD. For instance, suppose there was a ceasefire or peace deal in Ukraine, and this would probably cause the euro to rally versus the dollar, as investors would see that Europe is a safer bet now that the geopolitical risk has subsided. Similarly, suppose that the Bank of Japan started raising interest rates. Now, this would probably cause the yen to rally versus the dollar, as higher interest rates would make the yen more attractive to hold versus the dollar. Anyway, as you can see, the Dixie rallied hard in 2022 because of the Fed's aggressive rate hikes. Lo and behold, the Dixie topped around the same time that the stock market and crypto market bottomed. Since that time, the Dixie has been gradually falling, and stocks and crypto have been gradually rising. At the time of shooting this video, it looks like the Dixie is on the brink of another leg lower, which would be bullish for the markets. And that actually reminds me, guys, given that we're focused on a short-term period from now until the end of the year, make sure to watch the Dixie on shorter time frames like the daily chart and the 4-hour chart. You'll be surprised to find how perfectly the markets reflect its price action. Are stocks and crypto starting to fall? Check the Dixie. Chances are it will be rising, and chances are it's because of the factor I just mentioned. And if you happen to see that stocks are rising but crypto is falling, then this means that a crypto-specific factor is driving the crypto prices. And this could be something like bad news related to regulations, a large crypto investor announcing they're selling, or a bullish catalyst being delayed. If it's affecting the entire crypto market and not just a couple of coins and tokens, it's probably something along these lines. However, if stocks are rallying but crypto is falling with no specific crypto catalyst, then this could be the sign of market manipulation. And some would say this is what happened during the dip in late September. Subsequent research by analysts like Andreas Steno Larsen suggests that this dip was likely due to the intentional liquidation of leveraged longs at a time when the markets were easier to manipulate. And this pertains to the crypto indicator you need to watch closely in the coming weeks, and that's Bitcoin dominance. Now, to quickly recap, Bitcoin dominance measures how much of the total crypto market cap is coming from Bitcoin versus other cryptos. Historically, the crypto market would top when Bitcoin dominance bottomed, but just like the Dixie, there are going to be a few bumps along the way. So, what causes Bitcoin dominance to go up or down? The short answer is a crypto rally where Bitcoin rallies more than everything else, or a crypto crash where Bitcoin crashes less than everything else. Now, to be clear, Bitcoin dominance going up does not necessarily mean that everything else is going down. It could just mean that Bitcoin is rallying more. And things that can cause Bitcoin to rally more than other cryptos are bullish catalysts specific to Bitcoin, like a strategic Bitcoin reserve. Conversely, things that cause Bitcoin to crash less are typically macro catalysts that result in a flight to safety within the crypto market. Bitcoin is seen as a safe haven within the crypto market, so when you see Bitcoin dominance rising during a crash, it tells you that there's a flight to safety. And this begs a bigger question though, and that's when exactly will Bitcoin dominance go up or down in Q4? In this case, there are two answers. The first answer is that Bitcoin dominance tends to get one big final spike higher during Q4. Contrary to popular belief, the final spike higher isn't usually caused by a crash. It's usually caused by a bullish catalyst that causes Bitcoin to rally to all-time highs for the cycle. And this rally to all-time highs attracts attention from investors, many of whom will see Bitcoin's six-figure price and say, "Damn, I can't afford that," and not understanding that you can of course buy a fraction of a Bitcoin. And the result is that speculative capital starts to rotate into altcoins, and Bitcoin dominance starts to fall. Because altcoins are more volatile than Bitcoin, this attracts more speculation, creating a positive feedback loop. Now, take a second to consider, when this dynamic occurs, where does that speculative capital flow to first? It's Ethereum, the second largest crypto. And this is extremely important to note because if you look under the hood of Bitcoin dominance, you'll notice that it consists mostly of large altcoins like Ethereum. It's exactly like how when you look under the hood of the Dixie, it's mostly the euro and the yen. Logically then, if we want to know where Bitcoin dominance is going, we also need to pay attention to where charts like ETH BTC and Sol BTC are going, just like Euro USD and JPY USD. Well, as you can see, ETH BTC seems to be close to a bottom, and it seems to be a similar story for Sol BTC, at least technically speaking. And this means that Bitcoin dominance could be close to hitting a local top before continuing lower. And this begs the biggest question of all. Where will Bitcoin dominance bottom? Well, historically speaking, since Bitcoin dominance has previously bottomed somewhere in the 40 to 45% range, the answer will likely be somewhere around there. And once you can see that Bitcoin dominance is approaching that range, then it means that the crypto market is close to a top. Add this indicator to your favorites and watch it closely. And this brings us to the part of the video you've all been waiting for. Figuring out how high your coins and tokens could go. And I'll start by saying that each crypto should be analyzed individually and that we don't have the time to do that for you in this video. That said, we can use some very basic technical analysis to get a sense of how big the crypto market as a whole could get. What you're looking at on this chart is the total 2ES, which is the total crypto market cap excluding Bitcoin and stablecoins. In other words, total 2ES is the total market cap of altcoins. Basic technical analysis suggests that the total 2ES is likely to grow to around $3 trillion, probably more when you factor in leverage in DeFi borrowing and all that fun stuff. At first glance, you might think, well, that's only a 2x. That sucks. But upon closer inspection, however, you'll realize that total 2ES is an index. It consists of high quality and low quality cryptos. Not sure if you've noticed, but most cryptos are low quality. And this means that most cryptos probably won't pump by much. And the result is that the average return of the overall altcoin index is lower. But if you focus on quality cryptos, the average return looks much better. We reckon the average return of quality altcoins is likely to be closer to a 4x. And even then, you have to remember that you're dealing with an average. Not to burst anyone's bubble, but large cap altcoins like ETH and XRP probably aren't going to 4x from here. Once again, this brings down the average return among quality altcoins. The further down you go in market cap rankings, the larger the returns are likely to be. But again, this assumes that you're focusing exclusively on quality altcoins. And if you don't know what quality altcoins are, then you can check out our video about how to do your own research and find those right over here. And if you're not subscribed to the channel yet, well, you can change that right now by hitting the subscribe button right over here. This is Nick signing off. Thank you guys very much for watching, and I will see you in the next video.